The CPI inflation report for the month of November was published on Tuesday, December 12th. It showed inflation has come down from the highs we saw last year, which could signal that the Fed is done hiking rates during the current economic cycle. However, inflation still remains very much elevated and well above the Fed's key target rate of 2%, as shelter costs still remain very much elevated. This is a huge challenge for the Fed because the Fed has very limited capabilities in order to tame shelter costs, because the increases to housing this year has mainly been driven by limited housing inventory. In today's video, I'll share all the details, including how this inflation report affected mortgage rates today. On top of that, I'll share when the Fed is expected to start decreasing rates next year. So thank you so much for joining me in today's video. I appreciate you. So here is what CNBC had to say. It says inflation slowed, keyword there slowed, to a 3.1% annual rate in November. This is all over the news on Tuesday, how inflation is slowing down. It says here a 2.3% decrease in energy prices helped keep inflation in check, as gasoline decreased by 6% and fuel oil fell by 2.7%. Now, when the media is talking about how inflation is slowing down, here's what they're talking about here. Here's headline inflation, which includes volatile prices for food and energy. This is called headline inflation. That increased by 3.1% this November compared to last November, which is on par with the forecast, but is decreased compared to the previous month. Because in October, headline inflation increased by 3.2%. Now it has decreased to 3.1%. Still increasing, but not increasing at the same rate we saw 1 month ago. Now, this is a partly good news here because we're actually well below the peak we had back in July last year, when headline inflation rose by 9.1%. It has been decreasing more or less ever since then. But look at the past 1 year though. Not a lot changed over the past several months regarding headline inflation in the US right now, especially compared to the previous month, going from 3.2 to 3.1%. Now have a look at this. Here is Core CPI, the Consumer Price Index. This excludes volatile energy and food prices. This is a key measure that the Fed tracks in order to get a measure of how inflation is doing here. So Core CPI, year over year, this is November last year compared to November this year, increased by 4%, in line with the forecast, and also the same compared to the previous month. And just like headline inflation, this is actually good because inflation has come down from the peak we saw last year at around 6.6%. Now it's a gain of 4%. However, though, just like headline inflation, we haven't seen much movement over the past several months here, which is bad because the Fed wants to see inflation coming down, right? Here's also a look at the changes compared to the previous month. So when we're seeing news headlines saying that inflation is slowing down, they're really talking about headline inflation compared to the previous month, year over year. Whereas core CPI actually increased. Look at this. The actual number was a gain of 0.3% compared to October, in line with the forecast though, but above the previous reading, a gain of 0.2%. And like this is, by the way, on investing.com, their economic calendar. It says here, core CPI is a key way to measure changes in purchasing trends and inflation. Again, a key measure that the Fed tracks in order to get a gauge about what inflation is doing right now. What I also found to be pretty wild as well is that core CPI on a month-to-month basis hasn't really changed very much over the past 6 months. So for example, back in July this year, we saw a gain of 0.2%. Then in August, another gain of 0.2%. The next month, a gain of 0.3%. And so on and so forth. So we are seeing an increase of core CPI on a month-to-month basis, which means that inflation overall is still remaining very much sticky here. Let's also have a look at what the National Association of Home Builders had to say regarding this new inflation report just announced today here. The ongoing slowdown in inflation, again, the year-over-year change compared to the previous month, The ongoing slowdown in inflation increases the probability that the Fed is done increasing rates. However, even after peaking in March this year, shelter costs continue to put upward pressure on inflation, accounting for nearly 70% of the total increase of all items, excluding food and energy. So core CPI, the increase made up about 70% of the gains of shelter costs. The Fed's ability to address rising housing costs is limited because increases of shelter costs are driven by a lack of affordable supply and increasing development costs. Of course, one of the main reasons why shelter costs have been rising this year is due to a limited amount of housing inventory. Additional housing supply is the primary solution to tame housing inflation. I absolutely 100% agree with this, because if we see a huge surge of inventory levels or number of houses for sale, rental units, that should tame shelter costs. The Fed's tools, however, though, for promoting housing supply are limited at best. The Fed, again, controls the federal funds rate, which is the overnight rate that banks charge each other for lending each other money. That's based on reserve requirements that's implemented by the government here. But the Fed has very limited capabilities in order to increase supply. They also talk about here how we have the high cost of acquisition, development, and construction financing as well. I will share some more information regarding this increase development costs for home builders. But first, let's have a look at what happened with the 10-year Treasury note. So right now, at the time of filming this video, which is around 2 p.m. Eastern Standard Time on Tuesday, we're at 4.2%, a small decrease of about 4 basis points compared to yesterday. And because the 10-year decreased slightly today, this is one of the reasons why the average for a 30-year fix actually decreased by 1 basis point. So the average for people with great credit who have at least a 80% loan to value ratio, in other words, if you're buying a house, you're putting down at least 20% down, and your FICO score is over 740. So again, these are the best rates on average on a national level if you have great credit. So the average right now for a 30-year fix is at 7.09%. That's according to the Mortgage News Daily. 15-year is at 6.5, jumbo 7.53%, and FHA and VA loans is at 6.42%. So not a lot of movement regarding what happened with rates today. But have a look at this. Here's a look at the CME Fed Watch tool. If you just Google that, it has a look at the likelihood that the Fed will change the federal funds rate at their upcoming FOMC meetings. So again, their next meeting is actually tomorrow, which is when I'm publishing this video here. But there's a 98.4% chance that the Fed will pause any rate hikes. So I don't think there's a lot of people at all who expect the Fed to increase rates tomorrow here. So a very strong likelihood that the Fed will pause rate hikes in December 13th. Looking at their first meeting of 2024, which is on January 31st, again, a very high probability that the Fed will pause. Then in March, a 55.4% chance will be at 5.5%. Again, another pause, but a 42% chance that the Fed will decrease rates by 25 basis points down to 5.25%. This is actually much different compared to what they were forecasting 1 month ago. So 1 month ago, there was only a 12.4% chance that the Fed was going to decrease rates by 25 basis points, and now it's at 42%. Let's also have a look at their next meeting, which is on May 1st next year. This is where we have more often than not of a chance of a Fed cut in interest rates. So about a 50.2% chance, the street here is forecasting, or I should say the CME group is expecting that the Fed will cut rates by 25 basis points to 5.25%. This is quite different compared to the forecast from 1 month ago, when they're forecasted at 29.6% chance that the Fed will cut rates. and now it's at 50.2%. It's also important to note here that there still is a 26.5% chance that the Fed will decrease rates down to 5%. So that'd be a 50 basis point decrease compared to the rates we have today. Okay, let's change gears slightly here and talk about how the increases of rates we've been seeing ever since really March of 2022 is really impacting the amount of building by home builders here. So according to the National Association of Home Builders, as of November 13th, it says during the third quarter this year, the availability of loans for residential land acquisition, development, and construction, which is AD&C loans, continued to tighten. Have a look at this. Here's a look at all these loans here. The blue line here is land acquisition, the interest rates for land acquisition. The red line is for land development, and the other two lines here in green and purple is for single family construction. Look at pre-COVID levels. Back in pre-COVID levels, the average rate for these residential construction loans was around 9%. Right now, it's in the range of 11 to nearly 15% right now. And rates have been increasing big time ever since the third quarter this year. I mention this because the cost of acquiring land or purchasing land by home builders and also for starting new home construction is very much higher compared to pre-pandemic levels. Here's another report I want to share with you guys, just posted on November 29th here from the Home Builders Association. It says the volume or the amount of total outstanding loans, which is AD&C loans, posted a decrease during the third quarter of 2023 as interest rates increased and financial conditions tightened. So here's a look at the year-over-year changes of residential construction loans ever since really 2013. As you can see here, during 2022 and the first part of 2023, big increases in the amount of residential construction loans. And right now, though, at least during the third quarter this year, posting the first decline on a year-over-year basis since 2021. On top of that, the current amount of existing residential AD&C loans now stands at about 51% lower than the peak levels we saw during the first quarter of 2008. To me, that really shows us how home building was just absolutely skyrocketing right before the Great Recession. And right now, the level of amount of houses that are being built and land being acquired is using these loans here still remains about 51% below 2008's levels. And coincidentally, have a look at this. Here is our good Uncle Fred here, and the source here is the US Census Bureau. This is the amount of housing starts for single family houses. So the beginning phase of the construction of a brand new house, going back to the year of 2000. So right now, at least for October, the most recent stats we have, the number of housing starts for single family houses on a seasonally adjusted annualized basis here is at 970,000. That's the current pace of housing starts right now on a national level. Compare this to 2008 though, or I should say 2006. The peak was right here, January 2006, when the pace of housing starts was at 1.8 million. So the level of housing starts right now is about half that back in January of 2006. So just taking a step back here, in my personal opinion, because inflation is not going down as much as the Fed wants to see, and again, we're seeing core CPI still increasing on a month-to-month basis. To me, this is telling me that inflation is still remaining very much sticky, and this high rate environment set by the Fed is going to last for several more months. Again, we're not going to see a pivot by the Fed until the spring months, potentially next year. Of course, a lot of data will be coming in. And of course, if inflation starts winding down further, of course, we may see a Fed pivot earlier than expected. However, though, if inflation still remains very much sticky, we should expect to see this high rate environment last longer, which of course will put downward pressure on prices, but also at the same time, also put downward pressure on people selling their houses, unless unemployment starts surging though. I'll say it again, I don't expect to see a surge of new listings or a surge of people listing their homes for sale unless they're being forced to because they're losing their jobs. But what do you guys think? Please comment below your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I appreciate that. Of course, I appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.